We are all at Jaipur Literature Festival 2023. And before I invite the enlightened panel, I would request, we love your posting and reposting, and keep tagging us at Jaipur Literature Festival 2023, and for tweets, use at Jaipur Litfest. We're delighted, ladies and gentlemen, to introduce the price of time, interest, capitalism, and the curse of easy money. And what a nice session on such a pleasant Sunday. Welcome again, all of you. All economic and financial activities take place across time. Interest is often described as the price of money, but it's better called the price of time. Time is scarce. Time has value. Interest is the time value of money. In The Price of Time, Edward Chancellor traces the history of interest from its origin in ancient Mesopotamia to the global credit blooms of the 21st century. In conversation with writer and economist Sanjeev Sanyal, Edward Chancellor is a leading financial historian. He is the author of Devil Take the Hindmost, A History of Financial Speculation. His latest book is The Price of Time, The Real Story of Interest. Sanjeev Sanyal is currently a member of Economic Advisory Council, to the Prime Minister. It's called EAC-PM. He was the principal economic advisor to the Finance Minister for 5 years till February 2022, and the co-chair of the G20's Framework Working Camp. He is the author of several best-selling books, including The Land of Seven Rivers, The Ocean of Churn, India in the Ages of Ideas, and The Indian Renaissance. His latest book is Revolutionaries. Ladies and gentlemen, I welcome upon the stage Edward Chancellor and Sanjeev Sanyal. Thank you, gentlemen, for joining us. And the floor is all yours, Sanjeev and Edward. Thank you.
I believe it's 12 o'clock. I've always wanted to say good noon to everybody. So this is my opportunity. And it's good to see that on a cold winter morning, there are actually people in Jaipur who want to discuss monetary policy. I wouldn't have imagined it, but it looks like it's a popular topic. And I have with me here Ed, who is a historian of the price of time, or the price of money, whichever way you prefer to think about interest rates. And he has a take on interest rates, which in some quarters would be considered heretical. So let me first attempt to describe what I think is his views of interest rates, and then I'll ask him to first explain the theory, then we'll get into perhaps the history of interest rates, and then maybe take up some of the topics relating to interest rates and what it means for today, where monetary policy is going through all kinds of difficulties following the COVID crisis. And not just the COVID crisis, a longer history going back at least to the financial crisis of 2007. So let me see if I can characterize your view of interest rates. His view, what I understand, is that the world faces a serious problem of cheap money. And cheap money is bad because it does two things. One is it creates all kinds of bubbles and distortions in the financial system, but also because it in some ways keeps alive zombies in the economy, and therefore doesn't allow the process of creative destruction that is critical for keeping the economy alive, in a sense. And this is, in some ways, a very supply-side view of interest rates, which is not very often discussed. Much of the debate on monetary policy and interest rates management tends to be a very demand management kind of view of the matter. So is that a correct characterization of your view of interest rates, or have I got it completely wrong?
No, I think that's a reasonably accurate view, and we could
You'll have to be a little louder
over the remaining part of the session.
So you have in your book a sort of history of how this how the price of money evolved. Can you give us a sort of quick overview of this, going back to ancient times and then maybe not to modern times, but maybe somewhere up to maybe Locke?
So I just give you the starting point of why I wrote the book is over the course of the last decade, interest rates had fallen to 0%.
They can't hear you, so...
Sorry, can you hear me now?
Yes.
Over the course of the last decade, interest rates fell to 0% in the Western world and negative in Europe and Japan. And I was working initially for an investment firm, and we were grappling with the consequences of these very low interest rates. And so I decided to look into the subject a bit more deeply. And the first thing one discovers is that the history of interest is an extremely ancient one, that the first origins of interest we find in ancient Mesopotamia in the 3rd millennium BC. So we have 5 millennia of interest and interest rate history. And never before had interest rates fallen to 0%. Never before in history. And if one looks in ancient Mesopotamia, one sees certain similarities of the function of interest that you might observe in the modern world. First of all, if you look at the ancient etymology for the word interest, it tends to be derived in the ancient languages for words relating to calves, to lambs, to kid goats. And from that, we can surmise that even in prehistorical periods, farmers were lending each other their grain and their livestock in order to other farmers who needed it and who were then charging some increment. So there's a link between the interest rate charged and the product of the loan, of the capital. We also find in ancient Mesopotamia that interest was used, charged on loans given to light industries, and also...
What sort of interest rates were they charging?
So there are two standard interest rates in ancient Mesopotamia. There's a 33% charge on barley loans, and there's a 25% charge, annual charge, on silver loans, which seems very high, but then there's some discussion as to whether the loan contracts actually sort of fudge the period at which the loans are made. So although there is a sort of statutory lending, statutory rate of interest, there is also a market rate of interest underlying it. We also see in ancient Mesopotamia that interest is used as a price of risk because we see that higher rates are charged for loans on commercial voyages overseas, where there's a risk of the ship sinking, and we find the same in the Middle Ages, what are called bottomry loans, charged at higher rates. We see interest charged on houses, on loans for houses, and only with the existence of interest can you actually have a housing market. In fact, without interest or without a discount rate, as you know, Sanjeev, it's impossible to put a valuation on any asset. So we talk about interest being the time value of money, and anyone who's been involved in finance or even studied economics knows that we use a discount rate on future income to arise at a present value. So if you look, as I say, it's extremely unlikely that a phenomenon such as interest would have appeared 5 millennia ago in ancient Mesopotamia, several millennia before the invention of coined money, before the Mesopotamians had even invented the wheel. It's that old. It's unlikely that we would have had this phenomenon unless it had served an essential function.
So now you move from that phase, and of course, these things become much more evolved by the Renaissance, and of course, India had a very well-developed system, financial system, interestingly based out of the temples. I don't know, many of you will be aware, ancient Indian temples were very famous for being full of gold. And the reason they had gold was not because, as many people think, is that the Indian princes were handing over all their gold to the temples. I can assure you, getting money off Indian politicians, even in ancient times, was a difficult thing. The reason they had that gold was they were actually financing these great voyages to all around the Indian Ocean, even out to the Pacific. And it was the temples who provided the venture capital to these great voyages of trade and discovery. So, so there is a very strong link between religious institutions, cultural institutions. There's a whole culture around interest rates. And of course, Christ turns up at the temple and kicks out the money lender. So there's also the response to that that happens.
Yeah, so that's a good point to make, because what one should bear in mind, and my book is an attempt to redress this, is that there's been, over most of the 5 millennia, a strong prejudice against the concept of interest at all. You find it in the Bible, you find it in ancient Mesopotamia. They had these, there was concerns about debt compounding over time, and when debt compounds over time and farmers are unable to pay their debts, they're liable to slip into debt bondage and then into slavery. And that happened both in Mesopotamia, in ancient Israel, in Greece, and in Rome. And from that, there is a well-founded distrust.
So this business of having a tilt towards easy money is an ancient thing.
Yes, or the abolition of interest. And there, many of you are probably familiar, that the Greek philosopher Aristotle claimed that interest was illegitimate. As he says, money was was created for use in exchange, but did not grow of its own accord. And those views of Aristotle were adopted by the Christian church and became were really the view of the Christian church in Europe through the Middle Ages. And my disagreement with Aristotle is that it would be correct to say that if I were to lend you some money and to immediately demand back more, that would be an unfair exchange. However, the loans take place across a period of time. And in his denunciation of interest or usury, Aristotle is ignoring the period of time. The argument of my book and the title of my book is that time is important. In fact, an American historian, economic historian, William Gertzman, writes that the invention of interest is the most important invention in the history of finance because interest allows one to transact across time. And as you find in the writing of Seneca, the Roman Stoic philosopher, that time is man's most precious possession. So it is very important that we use time efficiently and from an economic...
put a price to it.
And put a price to it. So without a price on time, then, and this is the argument of the second half of my book, then the financial and economic system begins to collapse.
So I'm going to skip a little because we'll run out of time otherwise. So let's get to the 19th and 20th centuries. You have here very elaborate systems of managing interest rates, including central banks that emerge. And of course, interest rates are both used as a tool, but also blamed for many things. So how would you think the evolution of our views of interest rate evolved, particularly in the 20th century, the variety of views between Hayek and Keynes and others, how they thought about interest rates, demand management, the evolution through to the late 20th century? how the Japanese tried to revive the economy, maybe some flavor of that. I know it's a big topic, but we have very limited time. So I wanted to drag you into that quickly.
So, I mean, the first point I'd make is just look at my book, the first half of the book looks at the history of interest in going into the modern period. And one thing one observes is that the great speculative bubbles in history, from the famous tulip mania in Holland in the 1630s onwards, coincide with periods of low interest rates. And in particular, I have a chapter on John Law, the Scottish adventurer, who went to France in the early 18th century, created the first private bank in France, then the first national bank. And John Law had this idea, which is very similar to the views of modern modern monetary economists. Law's idea was that France at the time was in a period of depression, that there was too much debt, prices were falling, the nobles were over-indebted, and Law's idea was, we'll get rid of a gold and silver money, replace it with paper money, print a lot of paper money, and bring down interest rates. He was also running this company called the Mississippi Company, which took over the government debt, assumed the government debt in exchange for payment, and Law, by bringing down interest rates from 8% to 2%, inflated the price of the Mississippi Company 20-fold in a short period of time. And he said, at that time, the high price of the Mississippi Company is justified by the low prevailing rate of interest. And then Law's system, which initially produced what we would now call asset price inflation, then produced a consumer price inflation, and the price level doubled, and Law was forced to withdraw his money, and as he withdrew his money, the Mississippi Company shares collapsed, and his whole, the introduction of paper money and his central bank also collapsed. So Law moved from a brief period to being the most powerful man in Europe and the richest man who had ever lived, to a man who was forced to flee France with just the coat on his back, leaving his family behind. And I think this is very instructive for the modern day, because the central bankers look towards Law, have looked towards Law, as the origin of the principles of modern central banking, and yet they ignored the failure of Law's great experiments. So over the last decade, we have conducted, in a way, a protracted rerun of the Law's Mississippi experiment, or what's called his system, and we're now facing a sort of juncture that Law reached as the system started to collapse.
So now, okay, so we have rapidly come to modern times. You have the 90s, the experiment in Japan. You keep cutting interest rates, but you just can't get prices to go up. So that is one experience. And then you have the other experience of Erdogan. He cuts interest rates and rather succeeds in getting prices to go up. How do you reconcile them? What is it that differentiates the two experiences?
Well, in the case of Japan, it had massive domestic savings. It had this great real estate bubble, the so-called bubble economy, and the huge amount of corporate debt. And at the end of that bubble economy, in 1990, Japan experienced a protracted period, not of sharp deflation, but of sort of mild deflation, and this ongoing property bust that lasted the best part of 2 decades. So there's the Japanese situation: high savings, huge amount of debt, but offset by these high savings. The Turkish situation is different. Turkey attracted a lot of foreign borrowing. The corporations got in debt, and there was also a real estate bubble in Turkey, but the currency collapsed because Turkey didn't have the domestic savings to hold it up, and now Turkey has very high inflation. And I write in the book that Erdogan he's always bewailing the high rates of interest. It belongs to the tradition of disparaging interest. And he fantasizes about what he calls the interest rate lobby, which is trying to destroy Turkey. And I say that if such a thing as an interest rate lobby exists, it has always existed to argue for lower rates, and Erdogan himself is its chief apologist.
So now, we are last decade. Interest rates are dramatically brought down. 2007-8 crisis pushes it down basically to zero. It comes back sort of very gingerly, and then you get hit by the COVID crisis, and it totally goes down to zero, in fact, negative in many cases. And I think your contention is that, I mean, on one hand, you have all these bubbles coming up, and we can have a debate whether the FTX and Bitcoins, etc., were also a part of that. But the fact of the matter is, you are making two cases here. One is that it is causing all this dislocation, but I got the sense from your book that you almost seem to suggest that this era of cheap money is keeping an entire zombie economy alive that doesn't allow a creative destruction, and in fact almost undermines the basis of Western civilization. Am I exaggerating?
Not particularly. I mean, people might say I was exaggerating, but you're fairly describing what I wrote. So the way I try to set it out in the book, particularly when we get into the era of zero negative rates, is to look at the various functions of interest. The modern view of central bankers, monetary policy makers, economists, is that the interest is really only needed as a lever to control inflation. I argue that in fact actually interest has a number of other roles, and we can break them down. First of all, as we've already mentioned, interest is an essential input into valuation. And when you bring interest rates down to zero or negative and take the discount rate down, you are then going to create asset price bubbles. In recent years, we have had what's known as the everything bubble, a bubble that incorporated the entire world, a variety of assets, of the US stock market. You had the so-called special purpose acquisition companies, the venture capital businesses, the so-called unicorns. You had the cryptocurrency bubble. You have bubbles in contemporary art. You even had bubbles recently in puppies, which now you'll be pleased to know that bubble has burst, and Bloomberg...
Puppies?
Yeah, the puppy bubble was a sort of COVID lockdown.
I've not seen anyone write on the puppy bubble.
Now, there was a piece in Bloomberg 2 days ago saying the price of cockapoos is down 85%, which is sort of slightly worse than Bitcoin, but in the same yardstick. So we had what's called the everything bubble, and as Warren Buffett says, interest is to valuation what gravity is to matter. So there's valuation. Then, with regards to the so-called zombies, interest determines the allocation of capital. It is the hurdle rate on your investment. So if you have very low rates of interest, you will have investments that produce returns, either very low returns or returns in the long distant future. And we have seen capital trapped in these so-called zombie companies, companies that have no profits, and if interest were higher, they would have gone out of business, and had they gone out of business, that capital would have been transferred to more productive purposes. So what we find with the zombie companies and sectors dominated by zombies, is you have low investment, low productivity, and few new entrants. And they're associated with low productivity growth, and if you get low productivity growth, you then get low income growth and low GDP growth. So that is another function of interest. Interest is also the price of borrowing or the price of leverage, and we see in the era of low interest a huge amount of leverage, of financial engineering, particularly in the United States, private equity boom, companies buying back shares. American companies have spent over the last decade trillions of dollars borrowing to buy back their shares and to acquire shares in other companies. And the amount of money used for financial engineering far exceeds the amount of money that is used for investment in the real economy. So when the interest rate is artificially low, you then actually find you find that real investment or the real economy is squeezed and distorted. And when interest, as I mentioned, interest is the price of risk, and when interest is very low, people are forced and obliged in order to maintain their investment income to take greater risk. So you get the cumulative effect of that is with bubbles, with high levels of debt, and with risk-taking and decline in underwriting standards, is to push the system towards another financial crisis, to build up financial instability. And that was really the thrust of the last section of the book. Some people have misread my book to say Chancellor wants interest rates to be higher, but in fact, had they read it more closely, they would have said Chancellor deplores the low rate of interest, but recognizes that if you raise interest rates from these currently low levels, the house of cards will come down. And as you know, we had the COVID bubble, and with the COVID bubble, as you mentioned, interest rates were once more in the West taken down to zero, and we got the last efflorescence of the everything bubble, and then the inflation that John Law witnessed in 1720 came into the system, and finally the central bankers woke up to their error and realized that they needed to pull the interest rate lever in order to control inflation. But in pulling that lever, they then immediately brought down the world's stock markets by, on average, 20% last year, and the world's bond markets by 20% last year too, and then started to collapse the so-called everything bubble. And so we're now at this juncture where we have to consider where we go from here.
So some of the audience will find some of this conversation quite interesting because India took a very different approach to economic management during the COVID shock, as you may be aware. Certainly the audience will be aware. We did do some monetary easing and fiscal easing, of course, like everybody else, but we did it in a more safety net sort of way by creating liquidity and guarantees and so on. We didn't slam interest rates down to zero like many Nobel laureates like Stiglitz were advising us to do. Instead, we were quite restrained in it, faced a lot of criticism personally on advocating that line of that approach. And interestingly, after a brief moratorium, actually allowing the insolvency and bankruptcy process to actually come back and begin working. In fact, through this crisis, one of our largest airlines, Jet Airways, actually shut down, and there was and so on. So we continued allowing that creative destruction process to play itself out. As I said, there was a period of moratorium during the peak lockdown, but other than that, we have actually taken a very different approach. Would you agree that was a more sensible approach? I would hope so.
It's your idea. How could I disagree with you? No, I mean, so think of lockdown. I mean, I was living I live in England, and when the lockdown came, and you saw, the government, both in Britain, Europe, United States, started borrowing vast sums of money to pay people to stay at home and to pay businesses to pay their workers. And my first point, and the British fiscal deficit, I think, rose to 15% of GDP, sort of wartime level, highest level of deficit outside of war. And my first thought was that the extravagance of lockdowns would never have been accepted had there been a cost on interest. In Britain, for instance, the Bank of England lent the government, indirectly by buying bonds in the market, £850 billion, and charged the government 10 basis points, that's 0.1% on that loan. Now, given at the time we had this woefully extravagant Prime Minister Boris Johnson in charge, whose own personal finances were a complete mess. You can see that there was an inducement to borrow and spend, and not to think of the huge amount of corruption and waste that was taking place. So I think that the lockdown, the debt finance lockdown, was in the West a consequence of the absurd and unnaturally cheap level of money. But there's a consequence to that, is that this debt is still there. And in fact, the debt is now, the government, as I say, owes the Bank of England £850 billion. And now interest rates are rising. Suddenly the cost of servicing the government debt is starting to rise. So this era of government profligacy is coming very rapidly to an end. The House of Lords report last year found that a 1% rise in short-term rates increased the cost of government debt financing by the equivalent of 1% of GDP. So you can see that incredible sensitivity of the government finances to to rises in interest. And since, as you'll know, Sanjeev, since the global financial crisis, countries like Britain, the debt level, the national debt relative to GDP has increased by roughly 3 times, so that our debt is over 100% of GDP. In the US, I think it's around 120% of GDP, roughly at the same level the US got to at the end of the Second World War. And as President Trump put it in 2020, no one cares about fiscal deficits. Well, of course they don't care about fiscal deficits when there is no cost to running those deficits, but eventually, as we know, these chickens come home to roost.
So one question before we ask for question, before I open it to the audience. So what's your prognosis looking forward? Okay, interest rates go up, house of cards comes down, and we go back to having low interest rates again. And so effectively, we are now, you would argue that we are stuck in this low interest rate, zombie Japanese sort of kind of ecosystem.
I don't actually necessarily think that's the outcome. As you remember, I mentioned before, Japan had very high domestic savings and enormous foreign assets, whereas places like the US is the largest international debtor in the world. Britain has a woefully low savings rate. And in fact, one of the functions of interest, which I haven't mentioned today, is an inducement to savings, and also a compounding your wealth over time. So if you take interest rates down to very low levels, you will have, as we see in the West, a very low savings. So there was much talk of a global savings glut, but I think the global savings glut was a chimera, mainly related to Chinese manipulation of its currency, but the reality has been very low rates of savings.
So what happens?
So what I think might happen is that the house of cards continues to collapse as the central banks raise interest rates to higher levels. And we see in the US, for instance, over the last 25 years, interest rates, as you know, Sanjeev, have peaked at each cycle at ever lower levels. The last cycle they peaked at 225 basis points. They're now roughly double that level. My analysis is correct. The system cannot bear such high rates of interest. In fact, we saw Bloomberg had a piece this week saying, I think, $225 billion of commercial real estate debt is already distressed. British financial regulator came out with the fact that 850,000 houses in the UK the households can't pay their mortgages. So I think we are on the cusp of very severe problems. I think that then what's likely, and this is conjecture, is that inflation comes down as the economy begins to, as the economy and financial system are very weak. And then I think the central bankers try one more time to lower interest rates and to print money. But I think now we've reached a turning point in which the lowering of interest and the injection of money into the system inflate asset prices, as it did in the last decade, but merely inflates consumer price inflation. So if that prognosis is correct, we're in for a period of low growth, economic and financial volatility, and of stagflation, of high, potentially high inflation. So it's not a very...
But at least if you're taking a year's perspective, I would say you're advising everybody here to buy long bonds and then invite you back. If we make money, we will celebrate. Otherwise, you'll have tomatoes and eggs thrown at you.
So no, I mean, I wouldn't buy the long nominal bonds. I don't know if India has inflation-protected bonds. Probably not. Do you have inflation?
Not really. That's not a liquid market.
So I mean, in the US, UK, and Europe, you have inflation-protected bonds. They were trading at very negative levels. So for instance, the UK 50-year index-linked bonds were trading at minus 2% at the end of 2021. So imagine that. You put your money down, and you're guaranteed to lose 2% a year until redemption in 50 years' time. Then, when interest rates started to rise, these bonds, these what we call gilt-edged securities, fell 85% in value. So that is, worse than cockapoodles, and it's worse than Bitcoin. But now, actually, they're reasonably well valued. So I think that from an investment perspective, in the US and UK, the index-linked bonds protect you against inflation and now offer positive returns. I'm quite positive on what my friend Felix Martin, another financial historian, calls the world's oldest bubble, namely gold. I think that we have had a period in which financial assets have been inflated, and now we shift from financial assets to real assets. And those real assets are gold, commodities, dare I say it, oil, and it is the real assets that I think will do better for preserving wealth over the course of the next decade.
So why don't we quickly ask some questions from the audience? There are lots of people interested. Take it somewhere in the middle, and what I'll do is take 3 questions right quickly from them, and you can answer them. Just take them somewhere here to people in... the gentleman here, and then take it. Not a long statement, quick question.
Hello.
Yeah.
Am I audible?
Yes.
You spoke about the history. I'm here. Right here, sir. In the front.
Right in front. Yeah, sorry.
Yeah. You spoke about the history of finance and about how the word for interest rate comes from sheep and all of that, right? So while a kid goat becomes a bigger goat and its value changes over time, that's understandable. At what point in history did we come to the understanding that even something that does not change in form, like gold, will actually after a point of time increase in value? At what point did we come to accept that inflation is a thing that just happens?
Can I ask one question?
Yeah, sure.
So, I mean, first of all, gold doesn't, there is no charge on gold. If you own gold, put it under your bed, it's not magically going to increase in value. The increase in value comes from lending your property to somebody else. For instance, if I lent you some gold, you could sell the gold, take that money, buy yourself a house, rent out the house, sell the house in a year's time, and you would have a bit more money. So it's only the use of capital, and you find, as I say, you find that in ancient Mesopotamia right through to the modern day. And in fact, when the Catholic Church eventually gave up its attempt to ban interest, it realized it was futile because merchants needed to borrow money, and it was only fair that the lender of money should partake in the potential profits.
You'll have to allow somebody else to ask another question, yeah? So just take it to somewhere in the middle row. Just go down the middle row, and give it to 2 people, give it to the gentleman there, and then to somebody else.
Hello.
Yeah.
The interest rate has many roles about the inflation, but the inflation is eventually going to go down. So there is a reason to increase interest rates for going down the inflation. It is necessary, or there are any other things we can do for the inflation to go down?
The point that he's making is interest
Yeah,
is
I
interest
got
rates
that.
a sensible way to manage inflation?
Yeah, I mean, so historically, before we had paper money, or what we call fiat currency system, when there was only a certain amount of gold in the central bank, when the gold left the central bank and left the country, the central bank would have, and that would happen during an inflationary credit boom, the bank would have the central bank would have no choice but to raise interest rates. So the role of interest as a lever to control inflation has always been around. But as Sanjeev, I'm sure, will tell you, there are other ways of doing it. There is the so-called fiscal theory of inflation, which, that large government deficits encourage inflation. So if you can keep government deficits under control, then that's one way of doing it. And Sanjeev is a supply-side man, so you probably would argue that if you make supply-side reforms, then that would also help control inflationary pressures.
Yeah, we have time for maybe one or two more. The gentleman here in the orange turban.
Thank you. Brilliant talk, panelists. So my question is similar to the previous question, but I'll digress a bit here. I want to talk about, so military Keynesianism, I would say, brought us out of the Great Depression. And I know that economists and economic historians especially shouldn't make predictions about the future. But what will be your prediction about an innovative model? Let's say interest rates are not working right now. But what can work to bring us out of the current fiasco that we are in? There is already a disconnect between finance and the real world economy. And if the financial system collapses at some point, what's the innovative way in the currently complex financial economy? What can bring us out of the next depression?
So how do you solve the problem that you...
So I think I mentioned that in the ancient world, we had these debt jubilees, which was just the forgiveness of debt. And that was... one quite neat way of dealing with an excessive build-up of debt. In the modern world, the debt jubilee is inflation. And that is the way, some of you think, if you look at your bank account, you might see that you have the same amount of money in your bank account as a year earlier. But in fact, at least in Britain, for instance, the value of that money has shrunk by 11% over the course of the last year. And in the age of paper money, we have had, and we'll look again at sterling or the dollar, they've lost, both of them, about 98 to 99% of their value over the course of the last 100 years. So I think that is, the default way of getting out the excess debt. In fact, one way of viewing inflation is a way of resolving distributional problems. When everyone wants a slice of the same pie and there isn't enough pie to go around, you just inflate the size of the pie. So my default view is not that the policymakers will come up with a magical solution, it's just they will allow inflation to run too high.
Yeah, if you can give it to a lady there with the specs, yeah.
Thank you. Thank you, Dr. Chancellor. That was a wonderful talk and book. My question is on digital currencies, which is an area that I study. Do you believe, apart from the speculation, that they change something fundamentally in the way that we might price money in the future or in finance in general? And I mean both CBDCs and crypto. What are your views on the fundamental shift they might bring?
A good question. So first of all, in my book, I argue that Bitcoin and the cryptocurrencies are not money. They're not money because they don't represent a claim on anything. They're not accepted by governments for payment of taxes, and they are not a store of wealth, and they can't even be used in exchange. So I think that the cryptocurrencies are, and this goes back to the collapse of the crypto exchange FTX. I think they're the purest bubble the world has ever seen. I mean, a bigger bubble than tulips, because at least tulips you can put in your garden. The Semper Augustus tulip that sold for the price of an Amsterdam townhouse was a beautiful object, whereas what's in a Bitcoin? You can't really do anything with it. The CBDCs, the central bank digital currencies, are a different kettle of fish. they have, as I argue at the end of the book, they have a potential to take us away from this unstable financial system based on banks creating money with loans, and you could have a central bank digital currency that was mandated to, by law, only to increase by a small amount every year, roughly in line with GDP growth. And then the cost of borrowing that digital currency would be, so to speak, the natural or market rate. And if the natural market rate prevailed, many of the problems, I think all of the problems that I mentioned of easy money, the asset price bubbles, excessive debt, would tend to go away. But there is a snag, which is that if you issue a CBDC, a central bank digital currency, you suck all the assets out of the banking system. And the banking system, therefore, has, itself would then face collapse, or it would have to radically reform itself. I would be in favor of that change, but we know that nothing useful ever happens in this world unless you actually move to a point of complete desperation. So it could be, if my analysis is correct, that you get to a severe financial crisis, and then that's an opportune moment for the Reserve Bank of India to offer the new gold standard, the new rupee, digital rupee, to compete with China's digital yuan. And then, I think a very well-managed...
See how that goes.
I think a well-managed CBDC would be a wonderful thing for a country to have.
Now, I've got a screen here flashing red with zeros on it. So we have literally run out of time. But I'm sure we will... Is there somewhere here we can sign books and things? So where is that? Right here? Okay. So some of us will be there. Both me and Ed will be there signing books. So let's bring this to a close. But before that, give him a big round of applause, please, ladies and gentlemen. Over to you.
Thank you. Thank you very much for this riveting and very interesting session on